I would just start by saying I'm super grateful for the organizers for putting our paper on the program. Very happy to kickstart this final paper session. And it's also great to continue my presence in this symposium. This paper is joined with Naiyu from Columbia. And the starting point of this paper is basically based on the idea that emerging market economies have gradually graduated from this idea of original sin, which means that they originally can only borrow in the foreign currencies, but not in the local currency of their own. But the recent trend seems to be that the foreigners are starting to hold a substantial share of local currency debt, mostly government debt, in their portfolio. And concurrently, there's going to be some increase in the turnover and the volume of offshore derivative trading. We know from some papers, very seminal contributions in the recent finance literature, on how the global investors' hedging practice seem to deviate a little bit from the theoretical benchmarks. But in this paper, we want to really focus on emerging market by looking at a subset of investors, mutual funds that are really focused on emerging market fixed income context. Why do you think it's interesting? I think from my perspective, it's interesting to focus on emerging market currencies and derivatives because they have high returns, high volatility, and you don't think that emerging market currencies are a good hedge for anything. So it will be interesting to see how some of the theoretical predictions, some priors say they want to hedge. These global investors wanted to hedge could potentially be justified in the data. But also, emerging market currencies are interesting on its own because of the severe market segmentations. So emerging market forwards are usually non-derivable, and there's market segmentation between the onshore and offshore. So typically, there are two different forward exchange rates associated with emerging market currencies. And our sponsor, CME, are actually leading a very nice initiative in terms of making these derivatives clearing. Central clearable. So this is really a unique setting to think about things like exchange rate, forward exchange rate dynamics in the presence of these segmented markets, which is very unique in the context of emerging market. And finally, there, as you see in the data, there are also diverse set of investors doing hedging, doing some speculating trades with respect to emerging market currencies through forwards. So when we think about things like exchange rate, it might be also important to account for these heterogeneities. So just a very quick words on the key message of our paper. We used a relatively novel data set on US mutual funds, dedicated emerging market mutual funds, currency hedging, and forward usage practice to document a few facts. And contrary to the potential prior that you think that in this environment, these investors wanted to hedge, they actually, on average, they're actively building their currency exposure. So on average, $1 of bond holding is corresponding to additional 14 cents of long forward position. And there are also cases where you invest in a currency not through bonds mostly, but only through forwards. So there are 5 currencies in our sample, on average, 2 currencies, they are exposed through forwards only. And the next question will be, why does this happen? And we ultimately trace to a very clear relationship, as basically correlates between capital controls, the difficulties through which these investors could put themselves onshore by accessing the local bond market with respect to their currency forward usage in the long direction. So the lower is the capital control measures, the lower is the net forward purchase. So we document in this paper a relatively strong correlation. Another thing is whether these funds are behaving in the same manner or is there any interesting heterogeneity? Because understanding this question is going to help us shed at least a little light on how this market structure works and how should we think about this we should think about forward exchange rate in this context. So we document that there are indeed different investment strategies revealed through heterogeneous forward usage patterns. We label funds as speculators if they're on average amplifying their the currency exposure through the use of forwards, and otherwise for hedge funds. And we show that speculative funds are typically big currency traders. Their net forward sales are related to currency level metrics, and they have much more currencies in terms of numbers relative to these hedge funds that we identify. But for the hedge funds, the standout feature of these funds is that the best predictor of the net forward sales next period, next quarter, is actually their bond position this quarter. So there is evidence suggesting that these hedge funds demonstrate some inelastic hedging demand. So the final part of the paper essentially tries to put all these empirical elements together into a theoretical framework for thinking about forward exchange rate, how capital controls, inelastic hedging demand, an additional set of speculative funds who are free to use these kind of forwards to get exposed to currencies could shape the drawing dynamics of these forward exchange rate, potentially with UIP deviations as well. So in our model, we are going to say something about the relationship between forward exchange rate and speculative positioning, as well as different types of capital control measures. So we're going to shed light on this. All right, so very quickly on the data. So we're using these SEC filings in particular for the mutual funds, combining filing NQ, NCSR versus also the import P, which tend to be a little bit more systematic after 2019. So we have our sample period starts from 2010 until 2013 Q3. And our fund sample is going to be those US domiciled mutual funds that are specialized in emerging market fixed income space. This is not necessarily the biggest amount of TNAs you will ever see in a paper, but as you can see later, we're going to show you that it does embed some interesting heterogeneities representing some funds with a little bit of motives to hedge, and also some funds who are using these derivatives relatively freely. So for most of our analysis, we're going to focus on these 20 major non-G10 currencies for which we have relatively good data on CIP deviations. And for this audience, I don't think I have to spend too much time on setting up the terminologies, but just in case we're going to be in the same line, I just want to mention that we are going to mostly focus on the net forward sales measure, which is the forward sales minus forward purchase. You can define this at the fund level, and you can also define this at the fund currency level, and you normalize this by the size of the funds, right? And so basically, a positive net forward sale conditional on a fund holding a long bond position means that they are really doing some hedging. They are reducing their local currency exposure through the use of forwards, and otherwise for negative net forward sales. And another measure you typically use in the literature is the hedge ratio, which is essentially the ratio between net forward sales and the scale of the bond position. We will notice in the later part of our analysis that because these emerging market dedicated mutual funds, they hold quite a lot of forwards, but potentially close to zero positions in terms of the bond denominated in the same currency, this hedge ratio measure could be a little bit more meaningless. So we are going to mostly focus on net forward sales. All right. Some of the more stylized facts here. So we can plot this distribution of net forward sales across different fund quarter observations in our sample, aggregated from fund currency level to the fund level. And you can see that most of the mass is actually it's actually geared towards the negative territory, which means that on average, these guys are essentially amplifying their currency exposure. Another way to see this is you can calculate this net currency exposure measure by subtracting net forward sales from bond weight, and you can use this 45-degree line to show that for most of the fund quarter observations, these dots are above the 45-degree line, which means that on average, these funds are really just amplifying their currency exposure through the use of forwards. You can also aggregate these measures at the currency level to have a sense of what do we miss if we are not counting these derivative exposure at the currency level. So think of your favorite, potentially you have some favorite cross-border currency exposure data set, which takes into account the cash position, but not taking into account the derivatives position. Here, on average, across these 20 currencies, we show that on average, you are going to miss around 25% of the total exposure of the currencies if you are only looking at the bond position. And also another interesting thing that I want to flag is this idea of a naked exposure, which means that they don't really have any underlying bond positions, but they are mostly exposed to a currency through forwards. And these green bars are actually particularly large for countries with relatively strong capital controls in place, the degree of difficulty of putting yourself onshore, for instance, China and India. Another way to systematically see the relationship is just basically to use a capital control index derived by the earlier literature to show that there is indeed a very strong negative relationship between net forward sales and capital controls. The higher is the degree of capital controls, like China and India, the more negative this net forward sale is going to be. So in a nutshell, they're essentially trying to use forwards to potentially construct synthetic exposure to a particular country. This is the aggregate observation at the sort of the currency level. But there are also very interesting heterogeneities. As I said, the reason for us to understand the heterogeneity at the fund level is to have a sense of how to think about kind of the market structure here. So we use a reveal preference approach to classify funds into whether they are systematically, on average, amplifying currency exposure through the use of forward purchase, or they are reducing their currency exposure through the use of forward sales. So we label them as either speculators or hedgers. So we are not using these ex-ante measure based on prospectus, essentially because prospectus contains very little information for us to distinguish between these funds. Most of the funds are going to state in their prospectus that they are going to use forwards for both hedging and synthetic exposure construction purposes, which means that we really have to look at what they do rather than what they say. Okay, so, and we uncover some heterogeneities. In terms of the number of portfolio currencies, speculative funds hold 2 times larger. And in terms of return, we do some return decomposition. Speculative funds are much, much more sensitive to emerging market currency fluctuation. It seemingly suggests that they are relatively more okay in terms of withstanding these currency fluctuation, currency risk. And their flow performance sensitivity is also relatively higher, potentially suggesting that they have a relatively higher risk-bearing capacity. Another thing that we want to uncover from the exercise is to understand the nature of demand for forwards for these different types of funds. So we do this through a relatively simple prediction exercise. So we predict future net forward sales based on this current quarter's currency level indicators, currency fundamentals, as well as the portfolio share of a particular currency in the bond portfolio of the particular fund. And what we see from these regressions, if you just focus on column 1 and column 3, is that speculators' net forward sales position are indeed relatively more sensitive to currency level indicators. But the best predictor of hedgers' position on net forward sales seems to be strongest in the case of bond rates. So it indicates that there is a substantial relationship between what you hold and what you want to do with the net forward sales. And this indicates that there is a little bit of evidence on the inelastic hedging demand associated with these hedge funds. So now we have a relatively better sense of this market where the speculators could potentially step into the market to accommodate these inelastic hedging demand by the hedgers, and in exchange get a return. And this is essentially the gist of our model. So we write down a relatively simple theoretical framework, putting these hedgers and speculators in the opposite realm of the market. So this is going to be a super simple model in the simplest setup. In the model, there's only going to be a hedger who wants to hedge a predetermined fraction of their bond exposure through the use of forwards. And there are speculators who can trade these NDFs, and they can do this. They can essentially take on the role of hedging service provision. And without showing you all the math here, essentially the equilibrium forward rate is going to determine by this particular equation relating this relative currency wedges, which is essentially the difference between the UIP deviations and the CIP deviations, to inelastic hedging demand associated with the hedgers, as well as the risk that these speculators has to bear when they do these kind of hedging service provision. And relative currency wedges here in this particular context also is related to the expected profits that these speculators are going to get by doing these type of hedging service provision. And so we go to the data to see if our model kind of makes sense in the data. And we show that in particular, for instance, we compute these currency wedge measures. And we show that on average, for most of the currencies, barring some anomalies, which we provide some explanations in the text, they are on average positive in our sample, which means that indeed speculators could find it profitable ex ante to engage in such a trade. But also, we can also directly measure relative to some of the models in this particular literature. We can also measure kind of the extent to which the hedging demand, inelastic hedging demand, is in place. And cross-sectionally, the bond share seems to, the currency wedge seems to be systematically increasing in the degree of hedge, the degree of inelastic hedging demand associated with hedger funds. And the other thing I want to show you, which is relatively like the latest edition of our paper, is actually trying to think a little bit harder about going back to this figure about capital controls. Right? So when we talk about capital controls, we tend to sort of talk about it along with, for instance, macroprudential, capital flow management, these type of relatively catchy terms. We tend to think of them as sort of like a one-size-fits-all, like super, super catchy terms without thinking about what's underlying these measures. So here, our model, once extended to a context where we allow for additional actors into the environment, as well as introducing explicitly different roles for capital controls, is going to help us shed light a little bit on the potentially complicated relationship between hedging costs associated with emerging market currencies versus the degree of capital controls in place. So in an extension of the model, which is not yet in the paper, we try to introduce capital controls in two ways. So one way is related to the left-hand side measure of this capital control index, which tend to measure the difficulty of foreign investors get onshore, the degree that they can access the local bond market. So this kind of onshore cost in our model is going to essentially, once we allow speculative funds to be able to trade both the local currency bond and the local currency forward, these are essentially substitutes. So that when speculators faces a higher cost to trade local currency bonds, they're just going to substitute to offshore forwards. And the additional supply forces is going to lower hedging costs. So indeed, if we look at the data, once we sort these currencies into portfolios with a relatively high versus relatively low speculative shares, then you can see that the forward discount is actually lowest in the currency portfolios with a lot of speculators presence. And these currencies, on average, tend to have relatively higher capital controls. So this is just one realm of thinking about capital controls. But there's also another layer, which is that there could be the case, given that there is substantial segmentation and some of these hedging demand is potentially going to be intermediated by some global banks, the global intermediaries that is going to establish certain connection with the local intermediaries. We can also introduce these type of players into the model to basically introduce a role for intermediation friction. So in our model, this is basically modeled by basically assuming that there's a probability that global banks cannot fully shed risk to the local intermediaries. Instead, once they have to hold these currency risks on their balance sheet, they're going to pay a cost. So a higher intermediation friction, which could also be considered one of the capital control measures, is going to have opposite implications on hedging costs. So essentially, the intuition here is that global banks retreat, speculator has to, by market clearing, speculator has to do more, and in equilibrium, they actually have to quote a higher compensation for taking the risk. This is very much consistent with the event study evidence associated with Malaysia in November 2016, when the central bank effectively issues a ban on offshore NDF trading of Malaysia rupiah, right? So effectively, you can't really ban these tradings, but there's always going to be some sort of policy risk associated with, especially the onshore entities in terms of executing these trades. So what we see is a very strong increase in the hedging costs measured by either CIP deviations or forward discount. So this increase in the hedging costs could be as high as several hundred basis points. So the nutshell of the message here is to think a little bit harder about the different types of capital controls, and the actors on which these capital controls are imposed is going to have different implications on the hedging cost. I'm going to conclude. So basically, the key message of the paper is that failing to account for these derivative exposure is potentially going to substantially understate the emerging market dedicated investors' true currency exposure. And we try to shed a little bit light on how is this market potentially structured, who are on the one side of the market, who are on the other side of the market. And we show that these speculative funds particularly could potentially serve as another intermediary of this hedging demand. And finally, through the model, we try to clarify the potential complicated relationship between capital control and hedging cost. So thank you very much, and I look forward to the discussion.
Okay, hi everyone. First of all, I'd like to thank the organizers for giving me the opportunity to discuss this really interesting paper on how US bond funds manage emerging market currency risk. Let me begin with the key takeaways. The paper shows that EM bond funds on average amplify rather than reduce currency exposure using forwards. At the currency level, aggregate forward positions are not well explained by currency fundamentals. Instead, currencies of countries with stricter capital controls are associated with net long forward positions, indicating that funds are using forwards to circumvent capital flow restrictions. The authors categorize funds into two types. Hedge funds take net short forward positions, likely to offset currency exposure coming from underlying investments. Speculator funds take net long forward positions, often without having any underlying exposure. They formalize this in a partial equilibrium framework where hedgers only partially hedge due to cost and risk considerations, and speculators absorb hedging demand in exchange for a risk premium. The model's predictions are largely supported by the empirical evidence. The paper has three main contributions. First, it uses a novel dataset on fund-level currency forward positions collected from SEC filings. Second, it shows that speculation, not just hedging, is widespread among EM bond funds. Third, it builds an equilibrium model linking forward premium to hedging demand and speculator risk aversion. Before I get to my comments, here is a useful summary from State Street showing the investment universe of EM debt, distinguishing between hard currency and local currency bonds. Now, this distinction is important because hard currency bonds denominated in US dollar carry no embedded currency risk, while local currency bonds do. Right? As we will see, funds often invest in both. They can also use forwards to create synthetic currency exposure while holding US dollar denominated debt. Here's my first comment, or question rather. Why do speculator funds amplify currency exposure? This behavior contrasts with the home currency bias in global bond portfolios documented by Majori et al. 2020 and with Campbell et al.'s recommendation of full hedging. Table 4 of the paper shows that speculators, on average, hold significantly less dollar-denominated assets compared to hedge funds. So this may indicate or reflect mandates that favor local currency exposure. Looking at funds prospectuses and quarterly reports, I observed two broad types of funds. The first type has explicit mandates to invest in local currency bonds or derivatives. Take MFS Emerging Markets Debt Local Currency Fund as an example. Its prospectus states it normally invests at least 80% of net assets in local currency denominated bonds and related derivatives. Yet, its 2018 NCSR report reveals significant dollar-denominated holdings, including Turkish sovereign US dollar bond, and also 11.7% net assets in US treasuries. Aggregating the investments by currency, only 68.4% of TNA was in local currency bonds. But the fund also held net long currency forward positions equal to 30% of TNA, bringing the total currency exposure to close to 99% of TNA, mostly in EM currencies. This calculation aligns with the currency exposure disclosed by the fund. Also, the fund is benchmarked against an EM local currency sovereign bond index. So this example illustrates how 4 positions that look speculative could at least in part be driven by the fund's desire to stay aligned with its investment mandate. For funds of this type, if they underinvest in local currency bonds, then forwards are a practical way for them to maintain exposure to the local currencies, especially when facing capital controls or limited bond market access. The second type of funds mainly invest in dollar-denominated assets or a mix of both hard currency and local currency bonds. They are typically benchmarked against US dollar indices, such as the JP Morgan EMBI index. Therefore, they have less incentive to amplify their currency exposure. The 3 funds I have on the slide made only limited use of currency forwards during their reporting period. Another related observation is that many fund families offer 2 versions of EM bond funds, one in local currency, one in hard currency. Okay, so I think it's worth exploring whether user type maps onto fund type. A good starting point is the CRISP database, which categorizes EM fixed income funds into EM debt funds and EM local currency debt funds. Fund name and fund benchmarks also help. So this mapping could shed light on systematic differences in forward usage. Turning to my second point on the key drivers of within fund across currency forward positions. Table 4 includes 4 determinants: portfolio weight in local currency, momentum, 3-month CIP deviation, and currency volatility. I think a broader set of variables should be considered. Now, these include portfolio weight in US dollar denominated EM bonds, as per my comment number 1. Interest rate differential relative to the US, which is a key driver of forward positions both in the literature and in practice. Macro risk indices, since emerging markets are more susceptible to economic and geopolitical shocks. Capital control index, which has already been highlighted in the paper as an important determinant of forward positions. And lastly, bid and ask spread as a measure of trading costs and liquidity. My third comment relates to several interesting findings in the paper that are not fully explained. So first, consider the possible coefficients on CIP deviation in Table 5. A higher cross-currency basis makes hedging more expensive for US-based investors. So the result seems to suggest that hedging demand increases with hedging costs. Alternatively, it could just reflect the negative correlation between UIP and CIP deviations documented by the Liu et al. 2025. So clarifying this potential channel could help us better understand the result. Second, during 2010 to 2012, there is a surge of fund-level net long forward positions, reaching 100% of TNA for a non-trivial fraction of funds in the sample. So my question is, what were the funds doing? Were they mainly obtaining currency exposure through forwards rather than bond investments? And what triggered this behavior? Third, following the enforcement of MYR and DF trading restrictions on Malaysian local entities, we see both speculators and hedgers reduce the size of their positions. But interestingly, hedgers started to resemble speculators with their net forward sell positions turning negative in 2017. So it's not clear why they would want to gain exposure to the currency. Did they maybe reduce their bond investment denominated in MYR? Because the definition of hedgers and speculators depends solely on the sign of the net forward position, it's difficult to pin down the exact motive. Lastly, the paper notes the use of G9 forwards, but does not examine the size of these positions. Some funds may be, or some speculators may be engaging in G9 carry trades, such as shorting yen to go long in EM currencies. So understanding the scale of these positions would help us understand whether funds are engaging in EM-specific strategies or taking broader currency bets. To conclude, this is a great paper with important and interesting findings. It highlights the central role of derivatives in EM bond portfolios and makes a valuable contribution to the growing literature on currency management in international investments. I'm very much looking forward to seeing the next version of the paper. Thank you.
I'd really like to thank Wei for a very comprehensive and thoughtful discussion about the paper, mostly on the empirical part. So a couple of responses. All the comments are obviously very much well taken, and we'll definitely go back and look at the data, especially thinking about benchmarks. This is something that's pretty much in progress. So we wanted to have a sense some of the sort of more deeper underlying possibilities that give rise to this difference between hedgers and speculators. And in terms of adding additional predictors into our predictive regression, I think I think it's a very fair point. Some of these predictors are already sort of absorbed by our inclusion of the fund quarter fixed effects, like these low and uncertain index, as well as the portfolio shares of emerging market currencies by particular funds. So, but some of the others, such as capital controls, we want to really just include them into the predictive framework, but typically in the data, they are quite slow moving. So, so typically we try to report the average across the time series just because there's not a lot of movements from, let's say, 2012 to 2014. But these are definitely something that we can explore. So yeah, I would look forward to collecting some questions.
Have you tried to relate the forward positions to fund flows? Because I'm thinking, if you're a local currency bond fund and you receive inflows, presumably in US dollars, you cannot every day invest in local currency bonds. It would be way too expensive. So you would like to minimize the tracking error by taking forward positions in these currencies, and then eventually maybe you take positions in the underlying bonds, and then you reduce. So it would be interesting to look at that. No?
Can take some more questions.
Sure.
Nice paper, excellent discussion. Related to Josef's point, I think in the discussions paper with Steve Rideau, for equities, they show that the cost to the investor is actually not that big, and it's just tracking error which increases. Do you have a sense of what the economic cost is of taking on too much currency risk?
Not a question in the
Yeah, great paper, Haonan. I have a question. When you aggregated all the forward position at the currency level, was it the case that even in countries without capital controls or little capital controls like Mexico, Brazil, the direction of the forwards is still towards speculating rather than hedging, or is that conditional on the on the bond portfolio only?
So maybe if you
Sure. Yeah, I'll take the first round. So Josef's question, very helpful. We at some point we thought about liquidity management incentive of currency forward usage. I think this is a super valid channel. We try to look at this by separating hedgers versus speculators, and we indeed find a little bit of evidence that the flow performance sensitivity seems to be quite large in the case of speculative funds. So in the sense that they conditional on having the same performance, fund flows are more sensitive. In the case of speculators, they might want to use some forwards, use a little bit more forwards to sort of to just build some liquidity buffers. But we are not able to use these kind of relatively simple metrics. We're not able to distinguish this between whether they are just basically the fund managers are basically very skilled or very risk loving versus liquidity management. This is something that we need to check a little bit. In terms of the fees and so on, the hedge funds and speculative funds are not super different in terms of the fees of investing in these funds. And to Andrea's question on, so I have to think a little bit on the economic cost. But the tracking errors, we try to look at this a little bit. So Ray also mentioned that there are some funds in our sample which invest both in local currency and US dollar. And some of them state in their prospectus that they're following some dollar index, and there's some funds they're following some local currency index. So they're not passively tracking the index. There is a sense of activeness here. So I have to go back and check very precisely how these tracking errors kind of shows up, and also the economic costs. I have to think about it. And to Mike's question, yeah, so the degree of speculative positioning or positive forward positioning is indeed decreasing in the degree of openness, right? But except in the case of Brazil, we don't find significant evidence that they are turning the sign. So Brazil has a little bit of negative net forward position on aggregate for these emerging market dedicated funds, but for most of the other currencies that we investigate, most of them are still negative. So synthetic exposure is still potentially a reason that's potentially not necessarily directly related to capital controls, but mostly potentially for the liquidity and other reasons.
Any more questions? Joseph, please.
Firstly, just a clarification. To separate the hedgers and the speculators, are you doing that based on the sign of their position, sort of on average through time, or? Okay, in which case, there's potentially on the side of the hedgers, hedgers who are still following sort of speculative behavior if they're doing an active hedging approach, and so they might persistently only have short positions, but they still could be, if you're then comparing it to, I don't know, signals or for the speculators, that could still apply to the hedgers. And then on the other side, you could have speculators who have long short positions in the M. So I suspect on both sides it could be relatively small, but those are one thing on each side which could affect it, possibly hard to tease out of the data.
Yeah, indeed, this is a good point in the sense that we know that assigning a labeling such as hedgers and speculators is never going to be sort of one directional, especially when it comes to speculators. So one thing that we find in the data is that once we separate these hedger and versus speculator funds into these kind of classifications, the average hedge ratio of these hedger funds are actually on average 30%. So they're significantly higher, and they're significantly positive in terms of the hedge ratio. And if you look at the net forward sales, the evolution of the net forward sales is quite stable. There's not a lot of transition in and out of these kind of status if we look at specific currencies. But I think this is a super valid point. The other thing is that there is a sense that speculators are sort of, in our sample, are sort of, we define it as basically just taking the long directions. But a better way of thinking about the labeling is just whether they are sort of using forwards on average to amplify their exposure rather than decreasing their exposure. Because our definition of these hedgers and speculators are based on aggregate forwards across every currencies. So this is more of a fund level measure. They could indeed place some speculative positioning on the other direction for a subset of the currencies. And indeed, we find these kind of information. But as long as there's a substantial difference in the hedge ratio between hedge funds and speculative funds, I think our classification could be relatively more justified. Yeah. Thank you.
Okay, thank you very much.
Yep.